What is a credit tenant? If you're investing in retail and shopping centers, you'll definitely want to listen to this. Hi, I'm Tim Diesel. I'm a commercial real estate consultant. This channel is designed to help you in your investment career and really grow. If you're a broker, this will definitely help your clients grow as well. All right, so let's get right into it. A credit tenant is a tenant that has strong financials. So they're referred to as a credit tenant, right? So if you have a retail shopping center and you have a John's Pizza, that's not exactly a credit tenant. But if you have a CVS, a Walgreens, Taco Bell, Burger King, those are credit tenants, right? So they're referred to as national tenants sometimes because they have a national footprint, regional tenants, they're larger tenants. And this gives the perception that the property is worth more. It's only worth the value of the lease. So if you have 2 more years coming up on that credit tenant and they have no plans of sticking around, the value is considerably less. So a credit tenant is very, very good to have, but there are some downsides too. And let me explain those to you a little bit. All right, so it's very good to have a credit tenant. It's fantastic. You have a Walgreens, they're in your property for 5, 10, 15 years, maybe 20, who knows, right? The issue comes in when, all right, so it's very good to have a Walgreens or a Walmart, Burger King, have them in your property for 5, 10, 15, 20 years. The issue is it's very difficult to grow the value of your property when you have a tenant in there for 10 years, because usually it's a very small lease increase. It's like 3%. So if they're in there for 5, 10, or 15, 20 years, that's 20 years that you have not been able to adjust those rents to what the market is actually asking for. That's the bad news. The good news is you have a very stable property and you have a stable income stream. And if it comes down to sell it and you've got 10 years left on that lease, you're gonna be able to sell it no problem, right? Because people are looking for those cash flows. Now, the credit tenant is determined by a credit agency, right? So they'll be able to rank those credit tenants, those high quality tenants. So it's kind of like a credit report. And I don't wanna get too much and complicate it, but they're gauging the financial strength of the tenant that's occupying the space. And there isn't thousands and thousands of them. There's very few, and they're usually pretty strong, and we've all heard of them. So that's how those are determined. So if you're going to rent to a small business, the sad reality is the average small business lasts 3 to 5 years, then they're gone. So, and I've helped a lot of these tenants get into spaces and they don't last very long. Usually after a year or two, I'm talking to a business broker and we need to sell the business or liquidate whatever's there. That's the unfortunate side. That's why there's a lot of large shopping centers that really want to know what's the financial strength of the business. They don't like startups. They really like to see you've got a lot of cash, you have a lot of reserves. They don't want to just let anybody in there. So that's kind of the protection that has to be there. It's not always guaranteed, right? I mean, look at the big companies, Toys R Us, and I mean, the list goes on. And not to badmouth those companies, but the truth is anybody can go under. You just really need to be prepared and protect yourself as much as possible. Now, you'll probably also have heard of credit tenant leases. And you'll see those more in a standalone building like a Walgreens, where they're maybe 5 or 10 or 15 years and they have a lease on the property, or they lend based on that credit tenant lease. A lot of these are kind of a bonded lease, a bond, not a loan. So they'll refer to them as a bond. And they'll have higher LTVs and they'll have lower DCRs. So if you haven't seen my video on debt coverage ratio, you should definitely check that one out because I explain that a little bit more. So there are advantages to putting those tenants in there, right? Because you're protects your property a little bit. The biggest downside is you really cannot raise that rent fast enough. So it's kind of a double-edged sword. Really, you just depends on what side you like. How are you looking more for safety, security, or are you looking more for value-added opportunities? So it's just really up to you, and there is no right or wrong. All right, so another little tip I can give you is if you're buying retail property, a shopping center or something like that, don't go too crazy. I've mentioned this before. Stick around 7, 8, 10,000 square feet, because if you're gonna do a single tenant property, it's a little tougher unless you have the great corner, great visibility, and someone really wants it. It's gonna be a lot tougher to rent because you're looking for a Dollar General, you're looking for CVS, you're really looking for someone big enough that'll take that one down. The problem is once they leave, now you've got to chop up the space, or you're gonna have a real tough time finding something like that. Smaller space, usually if it's 1,000 square feet, they don't stay there a terribly long time. And that's in warehouse, office, retail. They usually don't stay unless that's a bigger space. So if you have a bigger space, 4, 5, 6,000, the impression is you're gonna have a 3, a 5, or a 7-year deal, because you're not gonna rent 10,000 square feet for 1 year. That wouldn't make very much sense, right? Most of the time. So keep an eye on that and really look at your investing as a global whole and what is the best approach to take. And it's different for everybody. All right, like this video, subscribe to this channel, ask me any question you have, or leave a comment below. I'd love to get back to you on it. Thank you guys so much for watching.